taking a look at the markets right now, with things having quietened down on the company news front, a lot of focus on macroeconomics at this stage of the game and a lot of focus on disappointing data that's filtered through on the global economic scene.
Definitely, Alishia. I think it all started in the US last week from Wednesday onwards. Just a slew of poor economic data, especially on the jobs front. And of course, with an economy that is 80% weighted towards the consumer, if you're not creating jobs, you're of course not in a position really to grow that economy by any significant measures. So, but despite all the cash that has been thrown at the system, QE2 supposed to be coming to an end fairly shortly, it doesn't seem as though they've really been able to translate that into proper economic growth. So as you quite rightly point out, very little company specific news at the moment, so all the focus back on the economy at the moment, and it really does not look great out there. So 6 days in a row now of negative performance from the US markets, and certainly not looking much better elsewhere. So not a lot of direction at the moment. We've got futures closeout coming up next week in our own market as well as in the UK market. So the market is now looking more at the economic numbers as well as some structural issues for movement and direction rather than any company-specific news at the moment.
And looking at some of that macroeconomic data, a lot of focus on the interest rate decision that's set to emerge later this afternoon out of both the BoE and ECB. What are your expectations in that regard?
It's quite interesting. When we look back 3 months ago, already the noises were being made at the time that they might have to look at raising interest rates in April and May. We're in June, and not only have rates not been increased in either of those markets, but we're not expecting them to be increased today. I think that's certainly indicative of the poor growth outlook that we have, certainly in both the Euro and the UK region as well. So we're not expecting those rates to be increased. The focus will certainly be on the comments. How hawkish are they in terms of what they say in their outlook, when they expect to be looking for interest rates increases. And I guess if one of them should shock the market and actually do increase rates, I guess the initial reaction would certainly be that you'll have a flow of capital to that particular market looking for that higher yield, those higher rates, but probably depending on the reason why they could potentially raise, might very well turn that around and say if they need to raise the rates, maybe the outlook is not that great, and we actually need to turn it around again. So expectation is not for any rate increase, but if there is a move in either one of those two markets, it might cause a bit of volatility in both currencies as well as bond markets.
Nerina, you touched that you're also looking at structural issues at this stage of the game, and taking a look at that, we've got things like index reviews that are becoming increasingly important. We've seen more light being shed with regards to that. For example, on the top 40, Pick and Pay out, and Assore in.
That's quite right. A week ago, that's what we said we would be expecting. It was yesterday. It was the Index Advisory Committee at the JSE who had their quarterly meeting, and they announced those changes first thing this morning, and confirmation of that Pick and Pay would be dropped from the top 40 index to be replaced by Assore. Pick and Pay is also dropped from the Financial and Industrial top 30 index, and there it's being replaced by MMI. Really indicative, I think, of the woes of Pick and Pay over recent months, because it's really the decline in its market cap that have resulted in it being automatically dropped from these indices. But the other news that is also out around that is that the Dividend Plus Index, which is an index which is only reviewed twice a year, is reviewed at this June quarter. Now, just a reminder that the Dividend Plus Index is quite different than most of the other indices that we're more familiar with, as both the selection of the stocks that go into it as well as the weight of those stocks in the indices are based on the dividend yield, the forward dividend yield of those companies, rather than their market capitalization. So it's often interesting to look at not only who those top constituents are, but also to look at the market movement that would come about because of those changes. And we see based on this review that right at the top of the list there is Kumba, followed by Brait, a new entrant into that market, and both of them currently sitting on a forward dividend yield in excess of 10%. 10%. So those are quite significant dividend expectations by analysts around those companies. As we move down the list, we see many of our insurance companies. We see PPC there, for example. So a lot of the companies in this dividend yield index are paying dividends in excess of 5 or 6% per annum, or is expected to pay that. So it is not surprising then to see that the ETF that tracks this index over the last 3 years has been one of the top performing investments in South Africa, and it's always interesting to monitor what happens in this index.
Also, other big news that the markets will be focusing on tomorrow is that we've got that effective date for the scheme arrangement of Massmart taking place, and that pertaining to Walmart taking up that 51% stake. Implications of that and the kind of movement you see around Massmart at this stage?
Yes, interesting to notice that the offer price is 148 Rand. The effective date, as you say, first thing tomorrow morning. So basically whoever owns that stock at the end of today will receive the 148 Rand for their shares. And yet the share is trading at only about 142 Rand at this stage. So one might question, why is the share not trading at the offer price? But Walmart is only taking up 51% of the Massmart shares. And what that clearly shows us is that the market is valuing the rest of Massmart, or Massmart as a business, at quite a bit of lower level than what Walmart is paying for it. If you do the sums, it really works out to around about 135, 136 Rand a share. So after that takeout this afternoon, when Walmart takes out their 51% of shares, we would expect what is left of the Massmart shares tomorrow to fall back probably to around about that level. And when you look at the implications of this scheme of arrangement, which is the formal process through which these shares will be acquired by Walmart, I think the first casualty in this is the derivatives guys, the futures and options guys, because if you are long a future and you have a hedged position, it means that you need to be short of the Massmart shares. You therefore have to go and buy at 148 in order to square up that position. I'm sorry, but you're only getting the lower price for that. So we didn't, when we were looking at who might be hurt in South Africa because of the Walmart Massmart deal, we certainly weren't expecting this to be the first casualty.
Well, we always know there are always winners and losers. Nerina, thanks so much for your time this afternoon.